Good morning, ARMR Insiders. Welcome to another edition of the morning meeting. Let's get ourselves ready for the trading session. We've been killing it so far this year, and I don't see that stopping us anytime soon. This bear market is rolling in, and we're prepared for it. So let's just take this morning, get our heads screwed on straight. That's what I try to do every morning here. Share the information that's important, share with you how I intend to use it. And I'll be honest, you guys are helping me become a much better trader, because when we do this every morning and we lay down what the process is and then we execute that strategy, we make money. It's the execution of the strategy that can lead you astray. So if we can all focus on what the process is and just keep executing it and try to get rid of the noise around us, we can excel. This is a protect capital market. So what we're going to do is break this conversation down into two pieces. Our day trading posture and what we'll be looking for to capture alpha, and what the investment posture is. Okay. So I think I want to start with the investing posture, because that's kind of the big picture, and then we'll drill down into how we're going to dance through the raindrops today. Don't forget, I'm sharing with you my own personal journey. This is how I run my own personal capital. You got to do your own due diligence. Make sure your risk tolerance are right for the things that I'm talking about. Make your own decisions. So get that disclaimer out of the way, as always. All right, but I think you guys know that by now. All right, let's dive right in. Let's look at a couple of charts to get ourselves ready to understand where we are. So first thing I want to do is, try to break this down for you in a cause and effect, type of way. So step one is risk monitor red, right? The risk monitor has been red ostensibly since December 3rd of 2021. So we go look at right here on this red day, right in here. This is the NASDAQ 100 now. Risk monitor went red. So for our index only portfolio, what that means is, how do we use that information? When the risk monitor goes red, what it tells us, and this is based on statistical analysis going back any decade you want to choose over the last probably 20 years. Okay, so any 10-year period over the last 20 years, you can look at 5-year periods. You're going to get the same information using the ARMR algorithms and the risk monitor. We have 7 indexes we follow. We have algorithms written for the 7. We look for confluence when all the indexes are doing the same thing. From a bullish point of view, that tells us institutions are putting money to work. That's when we put money to work. When we don't have the confluence and we go risk monitor red, that tells us one of two things. Either there's confusion in the market and there's rotation in the market, which will lead to a consolidation and then a buy signal. Or there's confusion, rotation in the market's not working, and it's going to lead to a bear market. Those are the two scenarios of risk monitor red. I guess there's a third scenario. Every now and then we'll get risk monitor red. In fact, we saw this last year a couple times. Risk monitor red, and within a week, we were risk monitor green again. Now, that's the key piece of information over the last 2 months. When the risk monitor changes red and immediately recovers, you're in a bull market. When the risk monitor changes red and can't recover, okay, you can see here, we had a bit of a yellow signal, but even that, we were like, this is just not right, but market's trying to come out, but there's no confluence, okay? And if we go look at the S&P here, just as another example, okay, same situation here, red, it kind of couldn't go green, so we have all reds and yellows up here. The last green was back here, okay? What that was telling us is that we're headed towards a bear market, because the red signal didn't turn green right away. That's indicative of a market top. That's what that signal was. So our index only portfolio, 100% cash. Our other portfolios with different disciplines, whether it be dividends or traditional, growth type of investing, or our swing trading, day trading, have different allocations of cash. Okay. And we've tried different things. The dividend portfolio has gone up during this period. Okay. So, but what it tells you is there's something wrong with the market. And the longer the risk monitor red persists, the closer you are to a negative dislocation in the market that we call bear market. Anybody following the ARMR report for the last couple of months has heard me talk about this every Saturday. There are rising wedges that are breaking down one after another. When you have a massive bull market that we had based on Fed liquidity additions, it doesn't go from a bull to a bear market immediately. There's a period of time of churning, institutional selling, distribution. So the market will go sideways for a couple months. Risk Monitor Red tells us there's something wrong. And then you start seeing one after another of these indexes, these 7 that we follow, breaking down, and it tells you that we're going into a bear market. So don't get hung up on the word bear market. By the way, by the time the traditional financial news media tells you it's a bear market, it's probably over. Okay, so everybody on CNBC loves to run around, arguing, debating bear market correction, blah, blah, blah. It's all a waste of time. The fact of the matter is you got to protect capital right now and call it whatever you want. When all the scholars are ready to agree that it's a bear market, the ARMR report will probably have a risk-on green signal. We'll probably start putting money back to work. All right. So we don't try to label things here, even though I call it a bear market to help people understand, because that's the label everyone knows. But in essence, from an ARMR report standpoint, risk monitor red for longer than a couple of weeks tells us there's something wrong. Now we see major breakdowns. So what we're in here is a protection of capital market. We'll capture upside second. Don't forget the ARMR report. I named it that. It stands for, it's an acronym, right? Algorithmic Risk Management Research. So what we do on this trading desk is we take all of our decisions and we look through a lens of risk first and how to manage it. And then we capture upside. Okay. And, over a long period of time, it allows us to build net worth and we avoid dramatic drawdowns. That's the point of the ARMR report in its essence, if I were to boil it down. And that's what we're doing right now. Markets are imploding, innovative stocks collapsing. We're not suffering from any of that. We have a lot of cash. We're protecting capital. We're making money day trading. The indexes, short yesterday, made a fortune on that sell-off. Okay. But long or short won't matter. That's what we do. And when the risk monitor turns green, that's when we start putting our capital to work again to capture the upside. All right. So what we're seeing here is just a completion of the breakdown of the big indexes that were held up by a handful of names. So the Nasdaq's broken down, the S&P's finally breaking down. But, I've been talking forever, I don't know, maybe forever, the last couple of weeks about this ugly rising wedge in the Dow and the problem of holding on to cyclical names. The danger of holding on to cyclical names is that the Dow is going to break down, which will tell you cyclical stocks are going to take it in the neck. And that's what's happening right now. Okay. And if you want to know how ugly it can get when you break down from a rising wedge, look no further than the innovative stocks, right? IBD 50. This is one of our 7 indexes we follow. There's the double top. We pointed it out back then, right? There's the breakdown of the rising wedge. We pointed it out early December when it was risk monitor red, right? And now it's just accelerating lower. Momentum stocks. These are the big cap tech stocks, big cap, not just tech, momentum stocks, right? They're just all imploding. Then, of course, so that's what it looks like when a rising wedge breaks. It gets ugly in a hurry. So that's what's happening in the Dow now, and that's why you've got to protect cyclical type of capital. That's why we reduced our MGA. We removed it. We removed our Visteon. We removed our Honeywell before they collapsed. Okay, because the rising wedge is breaking down. So it doesn't matter how great the idea is. We have to get out of the way, let it collapse, and then come back in. Maybe cyclicals are right, but they'll be right at some other point, right? This is why we booked our profit in something like, the steel stocks. I mean, they look like they're making a double bottom and breaking out. We booked a gain and they're imploding. Okay, so sticking with cyclicals is dangerous. So if you look at the ARMR portfolio and what's on the chopping block that I might reduce, I don't know. That Dow Chemical is in my dividend portfolio. I might not stay with that. I'm looking for excuses and reasons and places to raise capital. We reduced our exposure to Caterpillar and Deere yesterday. I'm using a 2-tiered stop. So I cut the position in half yesterday, booking gains, and I've raised my stop to the 50-day moving average. Theoretically, I should be out of them completely, but I got so much cash in the portfolio. I've booked half of my gains in Caterpillar and Deere. If we break below that black line, I'll get out of the rest. I'm just going to follow that strategy to its completion on those two positions. Okay. When it comes to the dividend stocks, I'm willing to stay with energy names, which are the pipelines, Exxon. I'm willing to stay with big cap pharmaceuticals, which usually do well in a bear market, even if they come down. I'm willing to stay with pure commodity backed, like Rio Tinto and BHP. It's tough to stay with those names, but I'm going to stay with those names, okay? Because they're commodity-backed assets, and I think we're at the beginning. I think 2022, when we look back, we're going to be in a commodity super cycle, and none of these stocks will hold up if the market implodes. So if we hit that, inflection point of margin, margin call selling, they're all going to get wrecked. And so if you're putting together a dividend portfolio and you can't deal with that swing, then you're not really a dividend investor. You're more of a swing trader, and you want to get out of those positions now because we have profits in Rio and we have profits in BHP, and we're probably going to give them all away if we have a bear market and we get, margin call selling. They're going to go right back down to where we bought them. So if you're a dividend investor, you don't care about that because you're going to collect your yield, and the underlying asset, which is that, the products that they're mining, prices are going higher this year, right? It's the commodity year. It's the inflation year. If that's true, then you're going to go through the swings and you're going to collect your yield. If you don't like that, and you got to get rid of everything with the exception of, utilities, telecom, even pharmaceutical and pipelines, energy pipelines, they're going to have less volatility. We're probably going to give up our gains there. We got gains in all the pipelines, gains in Exxon. We might give up those gains, but they're going to stay in that range. We keep collecting the yield. Okay. But probably Rio and BHP and Dow Chemical, these are things that you might experience more volatility than you want in your dividend portfolio. So you got to decide for yourself how you handle that. So anyway, getting back to the market, just the last thought here is the massive breakdown in the canary in the coal mine, right? So we've been talking about this for months. This is a huge top in small caps. They tried to break out, which was a bull trap. The gap back down told you the end was near, and that, the canary was having trouble singing, and now the canary is dead, right? And so it's just imploding, and the rest of the market's following. So to wrap up the segment on our thoughts on investing posture, we have risk monitor red, negative gamma environment, gapping down today after a collapse yesterday. Okay. Couple of thoughts. Let's talk crypto real quick, just for the fun of it. And I think I've earned it. Because I tried to explain this to everybody, and I know I'm speaking to ARMR insiders right now. You guys get it, but I'll probably release this video later today to the YouTube wild. Okay. And so I just want to say it. I think I've earned it. Okay. I tried to tell you when Bitcoin and Ether and all these cryptos were trading near their highs, that these are risk on assets. They are not a hedge. They will never be a hedge. Okay, Who knows? Maybe they will 10 years from now. I don't know. Could they develop into something different over time? Okay. I'll admit I don't have a crystal ball. Maybe they do. But in the here and now, crypto assets are the riskiest of risk-on assets. They're just like innovative growth stocks. I tried to say that. I shouted it from the rooftops when Bitcoin was 60,000 plus, right? Took a lot of abuse for it. Oh, Bitcoin's going to be 100,000 by the end of the year, Tom Lee, right? Those people were talking their book. They were overloaded on crypto, begging everybody else to hold it up. Crypto is a risk-on asset. You can play it. I'm not saying you can't invest in it. I'm not saying there's not a part of your asset base that should be there, I guess. Okay. But you have to understand what you're dealing with. You're playing with fire. It's a risk-on asset, just like any other innovative growth stock. And the chickens are coming home. That's what's going on right now. So there may be a moment when we're getting risk on green, where you see the ARMR report buying some crypto. But it's not going to be when crypto's skyrocketing and every fool on Reddit is telling me crypto and Bitcoin is going to go to 10 million by the year 2025. I mean, that was the top of the market if I've ever seen it. And I shared that with you, and I hope you guys protected capital. I hope. Because what I'm all about here at the ARMR report is algorithmic risk management research. Manage your risk. I'm the first to admit I didn't make the money I should have made on crypto on the way up. But if you give it all away because you pretend it's something that it's not, it's not very helpful to your asset base. Okay, so this is a lesson to be learned if you've gotten caught in that, because it's going to happen over and over again in your life. So get up off the mat, do what you have to do to protect yourself, live to fight another day, learn the lesson. Okay, gold and silver. Okay, Bitcoin is not the next gold. I don't even know why Bitcoin investors want it to be the next gold. It's its own thing. You don't want it to be gold. Being a precious metals owner is a labor of love. Okay, I mean, it is not easy. God forbid Bitcoin turns into the next gold. You're talking about a manipulated asset. Okay, you don't want that. But let's talk about gold right now. So the ARMR portfolios have about roughly 25% precious metals in the portfolio. Okay. Spread across really ETFs right now. Primarily, we're going to have our physical gold, Sprott physical gold, Sprott physical silver. Then we're going to have our allocation to the silver stocks through SILJ and the gold stocks through Nugget and UGT. So I want to say a couple things about that. Gold can be a hedge. Silver and gold can be a hedge. In the right market environment, an inflationary environment, in a super cycle of commodities, it could be a fantastic hedge. We could have a nirvana moment where the market's imploding and precious metals are going through the roof. Okay. But I'm also not delusional, and I don't want you to be. And I don't want you to be over your skis with like too much of this in the portfolio so you can't handle the swings. In a bear market, mining stocks are just stocks. And if the margin calls get ugly enough, we have a proverbial baby in the bathwater moment. So if you're over your skis on exposure on the metals in a market that's imploded, you're going to have some ugly mornings. And if that's going to get you off the bus, then it's going to be a disservice for you. So what you want to do is have a position you can manage the risk. You can deal with the swings. Don't be greedy. Now's not a time for greedy. And if you want to increase your position sizes, then what you do is you wait for those margin call moments when everything's imploding and gold and silver come down with it. In fact, gold and silver might go up that day and the mining stocks go down, which will be like frustrating to everybody. but it's just a function of baby and bathwater. So those are the days to add to positions. This is not a market to be adding to positions as they're exploding higher. Those are my thoughts for you on the metals. They're not magicians if the market's imploding. So we have our exposure, we manage that risk. And today it's a beautiful sight because the market's going lower again. Gold and silver were down overnight, down this morning. And right before I started this call at 8:30, gold and silver reversed. Gold is up now and silver's up now. And it looks like, the mining stocks are up right now. So that's a beautiful thing. But it's going to be very volatile. So be careful. All right, let's dive right into how we're going to be day trading the market. What's our day trading posture for the market? So let's go over what we did yesterday and then share what my process is today, what I'm looking for. So first of all, what's the information? We had a gap down. We have a gap down this morning from a prior day collapse. So this is the ARMR Day Trading playbook. How do we trade a gap down morning after a prior day collapse? When the risk monitor is red and it's a negative gamma environment, what do we do? Okay, so let's go over it. First of all, we have a bit of a look. We can look back at the playbook from yesterday, from 2 days ago. Okay, so 2 days ago we had a big down day and then the market gapped up in the morning. So what we looked for was the sell-off in the morning, which we got. This is the S&P, by the way. This is 3-minute charts. In fact, let me just open this up so you can look at the S&P, and because that's what we'll use as our guide. Okay, so what we did here was the playbook, and I shared this with you in the morning, was big down day yesterday, gap up in the morning. We look for the sell-off down to the prior day's lows, key location. We're going to get long, make some money on the rally. We captured the only profitable trade of the day, exited in here, right? And then the market imploded. So you could have been long here and then short again. I didn't do that on that particular day. Then what we had, so we had a huge down day and a gap up, big down day and a gap up. So this was a gap up that went up. And then yesterday, there was no entry point for me yesterday. It was just a gap and go. And I don't trade that in a negative gamma environment with the risk monitor red. I don't look for a gap and go day. And so instead it turned into a short day. And we had our short on right in here. Okay, made a little bit of money, popped back up, we exited. And then on this big down bar, we put a short on again. So to show you how we did this, and I'm sharing this with you in case you see it again today. So if the market, right now the market's going to gap down. So this is a different type of day, but this is what happened yesterday. Okay, so market was down huge, gapped up, rallied, set up a top, broke below the VWAP, you get short. Okay, we booked a little bit of profit. This took us out of the position, and then we immediately put the short back out on this bar. Okay, I didn't even wait for it to close that bar. I was actually shorting even before the bar closed. The minute it started to implode, I was getting short right in here. When it took out the low of that bar there, as I was getting short, the thing imploded, and we literally carried it all the way to the end of the day. I covered the last bar of my position with 2 minutes left of trading on this bar is where I covered the rest of it. Okay, so what we're looking at now, what we're going to see now is a gap down. We're so far away from put walls and prior days VWAPs that the trade I'm looking for today is what I like to call a real pure alpha capture trade. I come into the day with a lot of cash. The market plummets. My day trade portfolio is all cash, right? So the market plummets, I'm cash. So I have alpha the minute the market gaps down because I'm in cash. So I want to capture said alpha by getting long the market for the bounce back to the prior day's VWAP. That is a huge rally from here if it happens. Okay, the prior day's VWAP is here, this black dot. With the S&P, it typically follows the VWAPs. It always typically touches the VWAPs. So unless we're in literally a market crash, which could be, what we'll get is a gap down this morning, a rally up to test some level, a pullback double bottom scenario that we get all over for a rally that lasts the rest of the day. Okay. That either gets us back to the put wall, which is up here at 450 on the S&P, or up to the ARMR VWAP. Not all, VWAP gaps are filled the next day. They could get filled next week. So it's possible this is a gap down day, quiet day. We don't have that rip higher. But our job, having avoided a massive market sell-off this week, is to capture alpha. So in my mind, there's almost no risk of putting a trade on today when I see it set up. What is the risk of me putting on a long trade on the S&P and the NASDAQ when we get the setups, of course, and we'll be sharing all the information on the live trading desk so you can all follow along. We'll be watching these charts. We'll see it develop, and I'll show you, bang, there it is. There's the buy signal. Let's get long. And what I'm saying is when that happens, what's the risk? So we lose a little bit of money on that trade. It doesn't matter. We've avoided such massive decline in the market that the bigger risk is that we don't capture that alpha. We don't harvest the alpha we've created by being in cash. That would be the tragedy to me, because I'm going to put a position on and I'm going to have a fairly tight stop. If it hits the stop, I take a loss. Okay. And then I'll wait later in the day. It could set up later in the day. I'll put another trade on. And if I take a couple of small losses on a day where the market's down huge, I don't mind that, because I know if I execute the strategy over and over again, I'm going to harvest alpha and have a huge up day. So that's what I'm looking for on my trading desk. I'm not looking to get short. What would get me short? I say I'm not looking to get short, but what would get me short is a situation where the market gaps down and immediately rallies like it did yesterday. If it immediately rallies, sets up a top, breaks below the VWAP, we'll be getting short again. That's been a money trade day after day. So you can see right here, I didn't put this trade on, but I should have, right? That was a money trade right there. I was shocked the market imploded. I thought the market would rally because of Gamma and OPEX this week. I thought the market would rally this day. So I booked my profit on this entry point, but I didn't think short. I learned from that lesson yesterday, and I got short at the VWAP and made a lot of money. So if we have another day where we rally up to VWAP, so market gaps down, immediately rallies to VWAP and rolls over, well, I'll put a short on. Okay, so those are the two scenarios. I don't want to put a short on, but I will if it sets up like that. And the other scenario I really want is to harvest my alpha by finding that bottom. And what we usually look for is an hour-long sell-off. So the market's going to gap down. So the minute the market opens, the sell-off is started. So by 10:30, you'll have that hour-long sell-off. And when you get the buy signals after 10:30, you put the trade on because you have that structure. A new low on the day is the stop. A new low of the bar we're buying is the stop, depending on how it sets up. Okay. So that's what I'll be looking for as I'm day trading. Do you have any questions for me, ARMR Insiders? If not, we're going to split and go set up our live trading desk, and I'll see you all there at 9:15. Andrew's asking, should we be ready to cut our mining stocks in half? That is what I was saying. I'm not doing it right now, but I'm just saying if the selling gets ugly enough, look, the stop on GDX, and I'm using GDX as an example, but this is true for all, mining stocks. So GDX is just a collection of all the mining stocks. If we take out the low of the big up day, the trade's over. So that's the definite stop. Okay. If the selling gets ugly enough in the market, I could always see cutting my mining shares down for the simple reason of protecting capital. Okay. But I'm not looking to do that, Andrew. I don't want to do that. I want to leave them alone. I don't have an overexposure in my portfolio. So I feel 25% is the right number. So I'm going to leave that alone. And half of that, 25%, actually is the bullion itself. So 12.5% of my portfolio are in mining stocks right now. That's not the end of the world if they go down. I mean, so I'm probably going to carry them to the correct stop. But if the selling in the market gets ugly enough, everybody should look at their exposure and make sure they're not overexposed. That's the point of the call and the conversation this morning. All right. Kevin's offering a Chad style day trading name. I love that. We have Charmer stocks here, right? Chad, one of our ARMR insiders, real good at it over the last year or so, finding these stocks that skyrocket during the day. They're penny stocks or they're small stocks, small cap names. And I would just caution all of you, what worked in a raging bull market and can make a lot of money can be very dangerous in a risk monitor red, negative gamma environment. And when indexes, particularly the small cap index, is collapsing. So just be advised. Not that you can't make money doing it. I'm just saying, be advised. It's a much more dangerous endeavor. So perhaps position size adjustments are in order. All right. Okay, everybody have a great day trading today. I'll see you on the live trading desk. Of course, we'll be on the Slack room all day, sharing information as we see it and offering ideas on how to use that information. Okay, everybody stay safe, stay nimble. And remember, risk monitor red, negative gamma means capital preservation and protection is the key today. All right, see you on the flip side.